Markets don't crash quietly. They test every investor's mindset. From the 2008 financial crisis to the COVID-19 market crash, fear has always driven the crowd. But while many panic and sell, a few, like Warren Buffett, stay calm and build wealth. So what makes the difference? Welcome to My Money, Your Investment channel. Let's understand the mindset behind market crashes.
You are watching My Money, Your Investment channel.
Welcome to today's deep dive. We are really getting into it today. So I want you to imagine that you're on a commercial flight. You're cruising smoothly at, 30,000 feet.
Sounds nice.
Right. You're just, sipping a ginger ale, maybe reading a book. You're feeling totally secure. But then, out of nowhere, the floor just drops out from under you.
Oh, man. Yeah, the absolute worst feeling.
The overhead bins are rattling, the seatbelt sign violently dings on, and the pilot comes over the intercom and says, we've hit severe turbulence.
And your heart rate just spikes instantly.
Exactly.
Your grip on the armrest turns totally white. And it's a deeply visceral reaction, right?
Right.
Because your brain is perceiving this immediate life or death threat to your physical safety.
And in that exact moment of terror, the absolute worst thing you could possibly do is yank open the emergency exit door and jump out of the plane.
Yeah, that would be bad.
Really bad. You just need to keep your seatbelt fastened and ride it out. But every biological instinct in your body is screaming at you to escape the danger. Right.
Oh, absolutely.
And that exact biological misfire, that urge to jump, is exactly what destroys investor wealth during a market crash. We are unpacking a huge stack of research for this deep dive today, mainly anchored by this really comprehensive guide titled When Markets Crash.
Which is a great resource, by the way.
It really is. And our mission today is to arm you with the exact mindset and tactical tools to navigate financial downturns without panicking. Because the big reveal here, the fundamental premise, is that a market crash isn't just a financial event. It is fundamentally a psychological event.
That is the crux of the whole issue right there. We tend to view the stock market as this giant, rational, calculating machine, constantly pricing in variables and projecting future cash flows.
Right, like it's purely math.
Exactly.
Yeah.
But a crash strips all of that away. It totally exposes the raw human behavior underneath. And it triggers this dangerous, self-fulfilling feedback loop.
The panic loop.
The panic loop, yeah. Prices fall slightly because of some random catalyst. And that initial drop, it spikes fear. Fear drives investors to liquidate positions just to find safety.
Just trying to get out of the plane.
Precisely.
Oh.
And that mass liquidation, it drives prices down even further, which validates the initial fear and creates, even more of it.
So it's basically panic selling masquerading as rational risk management.
Yes.
The selling is being driven by the amygdala, not by a sober analysis of corporate balance sheets.
What's fascinating here is the cognitive dissonance this creates. And this is brilliantly captured in some of the research we pulled from Wikipedia and RCIV for this deep dive.
Yeah, that research was wild.
Right. Researchers actually looked at investor sentiment during major market contractions.
Yeah.
And when they surveyed investors during the thick of a crash, short-term pessimism was just completely off the charts.
Like end of the world stuff.
Totally. People genuinely believed the entire financial system was on the brink of collapse tomorrow. But here is the contradiction. When those exact same investors were asked about their long-term expectations, like where they thought the market would be in 10 years, their projections remained completely stable. They were statistically identical to their projections during a raging bull market.
Okay, let's unpack this, because that is wild. They know, logically and statistically, that the market will be fine and probably higher in a decade.
Right.
But they are still actively trying to jump out of the airplane today. The brain is holding two completely conflicting realities at the exact same time.
It really is.
We know jumping is financially fatal. So if our brains are just screaming at us that the portfolio is bleeding out, how do we actually trick ourselves into keeping that seatbelt fastened?
Well, first you have to understand the mechanism of why it hurts so much. And it comes down to a concept in behavioral economics called loss aversion.
Oh yeah, I love this concept.
It explains so much, right? Psychologically, the pain of losing $1,000 registers about twice as intensely in our brains as the joy of making $1,000.
So the sting is literally sharper.
Much sharper. When the market is dropping, you aren't just doing math, you are experiencing acute emotional pain. The guide points out that to survive this, the very first psychological hurdle is fundamentally reframing volatility.
Reframing it how?
By accepting that volatility is a normal part of the cycle. Crashes aren't these rare anomalies. 2008, 2020, they happened, and they eventually recovered. The core takeaway here is that volatility is not the risk. Your reaction to the volatility is the risk.
I was looking at the Schweitzer finance blog study we included in our sources, and it hits on exactly this. It points out that emotional trading during a downturn is the single most destructive behavior an investor can engage in.
Without a doubt.
And the primary trigger for that emotional trading, information overload. When the market is crashing, our instinct is to seek out information to gain a sense of control over the situation.
Yeah, we think more data will save us.
Exactly. So we obsessively check our portfolios, we doom scroll the financial news, we just stare at the red tickers flashing on the screen.
And every single time you check that portfolio and see a lower number, you are administering a fresh dose of cortisol straight to your brain.
Oh, wow. Just stressing yourself out on purpose?
Yeah, it creates a state of myopic loss aversion. I mean, if you check your portfolio every single day during a volatile year, you are going to see a loss roughly 50% of the time.
That's a lot of losing.
It is. And that constant exposure to perceived danger creates an overwhelming action bias. You feel this intense burning pressure to just do something to relieve the psychological tension. And usually that something is selling at the absolute bottom.
But I have to push back a little here.
Okay, go for it.
It's super easy to say, just put yourself on an information diet and don't look. But if you are managing your own life savings, looking away feels completely irresponsible.
I get that.
It feels like you're ignoring a fire in your kitchen. So are we just fundamentally hardwired to stare at the threat?
Yes, actually. Evolutionarily, ignoring a threat usually meant you got eaten by a tiger.
Right.
But the financial markets are a very recent invention, and our primal instincts are just wildly maladapted for them. Think about your kitchen fire analogy.
Yeah.
Panic selling during a market crash is like trying to put out a kitchen fire by turning on the gas.
Oh, man. Yeah.
Your reaction to the perceived threat is actually the very thing fueling the destruction of your wealth. By obsessively monitoring the daily fluctuations of a 30-year investment horizon, you are forcing your brain's short-term survival mechanism to manage a long-term abstract concept. It simply doesn't work.
So the mindset has to shift from I'm losing money to assets are on a discount.
Exactly.
Here's where it gets really interesting, because having a Zen mindset is great, but how does that translate into actual concrete decisions when your portfolio value is tanking?
Right, the tactical survival part.
Yeah, moving from the psychological to the tactical. The guide's primary golden rule is to stay invested, because trying to time the market getting out and getting back in is nearly impossible. The research from Crooked Tree Capital Advisors really highlights this. These aren't just financial strategies, they are behavioral hacks.
Precisely. Let's look at dollar cost averaging, or setting up a systematic investment plan in SIP. You're committing to investing a fixed dollar amount at regular intervals, regardless of what the market is doing.
So just putting in $500 a month, rain or shine.
Exactly. When you already know the mechanics of an SIP, you know that when prices drop, your fixed amount automatically buys more shares. But the real genius of an SIP isn't the math, it's the pre-commitment.
What do you mean by pre-commitment?
You make the decision to buy the dip when you are calm, rational, and setting up the automated transfer. When the crash actually happens, you don't have to summon the immense willpower required to log in and hit the buy button while the whole world is burning.
You just let the machine do it.
The system does it for you.
It completely removes the amygdala from the equation.
I love that. And the same behavioral trick applies to portfolio rebalancing, right?
It does, yeah.
We know the concept. You target a specific ratio, say 80% equities and 20% safe bonds. A crash wipes out your equity value, so your portfolio drifts to like 60% equities and 40% bonds.
Right.
To rebalance, you have to sell your safe, outperforming bonds to buy the free-falling, terrifying equities.
Right.
Which sounds crazy.
Which is agonizing to actually execute in the moment. It feels incredibly counterintuitive to sell the one thing in your portfolio that is actually holding its value, just to buy more of the asset that is currently incinerating the network. So mechanically, what is rebalancing forcing you to do? It is forcing you to sell high and buy low. It systemizes contrarianism. It forces you to act like a rational, cold-blooded institutional investor, even when your heart rate is through the roof.
And while we are talking about mechanical advantages, the research from Barron's brings up tax loss harvesting, which is fascinating.
Oh, this is a great one. It's basically a brilliant way to trick your brain into feeling a win during a massive drawdown. Because normally seeing red on your screen is just pure pain.
It's just awful.
But tax loss harvesting allows you to engineer a tax break out of that pain. It's like making lemonade out of lemons. You sell the losing asset to realize the capital loss, but you immediately buy a similar, highly correlated asset to maintain your market exposure.
If we connect this to the bigger picture, it's really about shifting the framing of the event. You aren't just sitting there helplessly watching your wealth evaporate.
Right.
You are actively utilizing the volatility to bank tax deductions that will offset future capital gains. So you're improving your long-term after-tax returns. It turns a passive, helpless situation into an active, empowering strategy. You get to feel clever instead of victimized.
That is such a powerful flip. But I'm looking at the guidelines from Kiplinger we pulled, and there's a tension here I really want to explore with you.
Okay, what's the tension?
The text aggressively advocates for keeping a strong liquidity buffer-like cash reserves to prevent forced selling during a crisis. But it also tells us we should be accumulating quality stocks because strong companies are caught in the broader market fire sale.
Right, yeah.
So how do you balance holding on to your cash life jacket while also trying to aggressively buy these generational discounts? If you deploy your cash into the market to buy the dip, you lose your safety net.
That's a great question. And the distinction lies in understanding the different tranches of your capital and establishing them long before the turbulence hits. Kiplinger emphasizes liquidity because the most tragic outcome of a crash is a forced liquidation.
Being forced to sell when you don't want to.
Exactly. If the market tanks, it often correlates with an economic recession. Right. If you lose your job and you don't have a 6-month emergency cash buffer, you are forced to sell your equities at the absolute bottom just to pay your mortgage.
And that's permanent.
It's a permanent destruction of capital. You can't recover from that.
So the emergency fund is strictly quarantined. It's the oxygen mask.
Yes. You never use the oxygen mask to buy stocks, no matter how cheap they look. The ability to buy the dip and accumulate quality stocks relies entirely on having secondary cash flows, like your ongoing salary or a dedicated opportunity fund that are entirely separate from your survival liquidity.
Ah, I see.
The cash buffer protects your life. The automated SIP and the opportunity fund buy the assets. If you mix the two, you expose yourself to catastrophic ruin.
So what does this all mean for the broader philosophy of the investor? We've talked about the tactical fail-safes, the SIP is the rebalancing, the tax harvesting, but the deep dive moves from these mechanical tricks to the overarching mindset of the true investor.
A long-term playbook.
Yeah. What separates the people who just barely survive a crash from the legends who actually use them to build massive wealth over decades?
It really comes down to what metric you're actually tracking. The amateur investor tracks the stock price. The true investor tracks the business fundamentals.
The actual company itself.
Right. During a severe crash, correlation across all asset classes goes to 1. Everything drops. Investors are selling anything they have just to raise cash. But a drop in stock price does not inherently mean a drop in the underlying value of the business.
I challenge that a bit, though.
Okay.
Because in a massive liquidity crisis like 2008, even fundamentally sound companies face existential threats because the credit markets just totally froze. Fundamentals don't matter much if you can't make payroll next week because the banks won't lend to you.
That is a crucial distinction, and it's exactly what a true investor is looking for amidst the wreckage. They're looking at the balance sheet.
Right.
Does this company have the cash reserves to survive a prolonged credit freeze? Is their debt manageable? Is their core revenue model still viable once the panic subsides? If a company has robust fundamentals and a fortress balance sheet, a 50% drop in their stock price is a massive dislocation between price and value.
So it's just a sale.
Exactly. Yeah. The true investor ignores the ticker tape and buys the underlying business at a massive discount.
Which perfectly aligns with the famous contrarian mindset the guide highlights, Be fearful when others are greedy, and greedy when others are fearful.
Classic Warren Buffett.
Yeah. But acting on that requires an incredible amount of discipline, primarily the discipline to just do nothing most of the time. We pulled another Arcus study that looked at the trading behavior of retail investors during volatile periods, and man, the data is brutal.
It really is.
It proves that excessive trading actively and consistently reduces investor wealth.
And it's not just because of the frictional costs like taxes and fees, it's the timing penalty. Retail investors notoriously overestimate their ability to predict short-term market movements.
Oh yeah, everyone thinks they can time it.
Right, they sell after the market has already dropped 20%, hoping to avoid further losses. Then the market has a sudden violent rally, which frequently happens during crashes, by the way, and they buy back in, thinking the coast is clear.
So they sell low and buy high.
They systematically sell the bottom and buy the top of the dead cat bounce. The more you tinker, the more you react to the noise, the worse your long-term performance becomes. Preparation is vastly more important than prediction.
Let me offer an analogy for this to kind of bring it home. Preparing for a market crash is exactly like building a storm shelter in Tornado Alley.
I like this.
You don't wake up every single morning looking at the atmospheric pressure, trying to predict the exact Tuesday a Category 5 will hit your specific neighborhood. That would be exhausting and completely impossible.
You drive yourself crazy.
Right. Instead, you just make sure your shelter is solidly built, reinforced, and fully stocked with supplies before tornado season even begins. Then, when the sirens finally go off and the storm hits, you don't run around outside in the wind trying to nail plywood to your windows.
No, you'd get swept away.
Exactly. You just sit inside your prepared structure, completely inactive, and wait for the weather to pass. The action was taken in the preparation, not the event.
This raises an important question, and it really serves as the ultimate synthesis of all the research we've unpacked today. Who is actually responsible for the destruction of wealth during a financial downturn?
That's the million-dollar question.
And the data makes it abundantly clear. Market crashes do not destroy wealth. Investor behavior destroys wealth.
Wow.
A market crash is merely a temporary repricing of assets. The actual permanent loss of capital only occurs when the human being looks at that temporary repricing, panics, and hits the sell button. The difference between success and failure in the financial markets isn't about having a genius-level IQ or access to algorithmic trading bots.
It's not a secret formula.
No, it is almost entirely an exercise in discipline, emotional control, and understanding your own psychological blind spots.
So, to you, the listener, the takeaway here is huge. In every single market crash, historically and in whatever future crashes are coming, there are two distinct groups of people. There are people who give in to the fight-or-flight response, sell their assets at the bottom to relieve the psychological pain, and lock in devastating, life-altering losses.
The ones jumping out of the plane.
Exactly. And then there are people who recognize the biological misfire for what it is. They stay calm, they trust their mechanical preparation, they buy the heavily discounted assets, and they build massive wealth for their future.
Right.
The market is ultimately a mechanism that transfers wealth from the impatient to the patient. Understanding this psychology is your personal armor for the next inevitable dip.
It's recognizing that the severe turbulence is simply the price of admission from long-term compounding. It's a feature of the system, not a bug.
Absolutely. But before we wrap up this deep dive, I want to leave you with a final thought to mull over, something that steps slightly outside the bounds of our source text today.
Okay, let's hear it.
The entire buy and hold strategy, the confidence to keep your seatbelt fastened, relies entirely on one massive historical assumption, that markets eventually recover because human economies tend to grow over time. We have centuries of data backing that up, driven by technological innovation and population growth.
Sure. Endless expansion.
Right. But what if we are entering a future era where that baseline assumption is fundamentally challenged? If we face a future of permanent global economic stagnation, perhaps driven by a sharply declining global population or, hard limits on global resources, how does an index fund perform in a permanently shrinking economy?
Oh, wow.
How would the patient investor have to adapt their psychological framework if the fundamental promise of endless long-term economic expansion is no longer guaranteed?
That is a deeply unsettling yet absolutely essential macro question to ponder as we look at the next 50 years of investing.
Definitely something to think about the next time you are tempted to check your portfolio app. Until then, just remember, when the turbulence hits, don't open the emergency exit, just keep your seatbelt fastened and let the plane fly through the storm.